Hi, this is Randy Finney with Right Side of the Chart, and this is a market wrap for the week ending Friday, July 27th, 2018. I will just look at the broad markets here real quick and maybe follow up with that VXX trade idea at the end. This is what happened today. We had a pretty clear and impulsive breakdown. This is the most recent trend line on the NQ. We're starting here with the NQ E-mini futures 60-minute chart. So these are hourly candlesticks, and that's where we were today. We broke down, and the fact that we moved impulsively lower helps to validate the breakdown. Trend lines. It certainly had enough reactions to consider it a valid trend line, especially the fact we're dancing over it here recently. And then the fact you had impulsive selling afterwards helps to validate that as an important level. So as you can see, we shot right down to this target I had here at 72.89. Uh, that's what I call this little extra bit there is what I call a momentum fueled overshoot when you have a strong downward move or upside move into resistance for that matter. But on the downside during a correction, you have that. It's just a term I made up called a momentum fueled overshoot. You have a lot of momentum velocity going down into there, just like the analogy I use is, throw a pitcher throws a fastball 90 miles an hour, catcher's glove is going to kick back a little bit to stop the ball. So that's kind of what happened today. Now, if we zoom in, there's something interesting to note here. Um, if we zoom in, and I'll show you this on QQQ in a second, this could get ugly next week. This is what appears to be a flagpole. You have a very impulsive move down. You guys probably know where I'm going with this. This appears to be a possible bear flag or bearish pennant right here, continuation pattern. We moved down in the trading room today. When we hit this level, I posted, that I was expecting a bounce, and then I added this target right here, 73.22. So if you watch the last update, this is the only line I've added to this chart. All these other lines were here in advance, and that one I put down there because there were quite a few reactions on that level. So I gamed a little bounce trade that was posted as a day trading op to just get a little trade off this here, that little move down to support back up to that level if you're an NQ trader. So it's certainly put a few pennies in your pocket. You don't need to move much in NQ to for every contract to make several hundred or a couple $1,000. So that's the resistance level that I believe this will fail at. In fact, okay, here we go. Here's the charts I posted in the trading room under the day trading group for anyone wanting to game a bounce. Once we hit this target, my expectation was for a little bounce, nothing much off there, and then eventually go on to continue down here and hit this. What I still am looking as my preferred swing target. All that means is I'm right now focused on the near-term charts, looking for just a pullback in the markets. Certainly has the potential to morph into something more. We'll hit on the long-term charts here in just a second and then keep this video kind of brief. But that's it. So afterwards, there was a bounce, and here was my scenario stated as such that I figured, this is where I went back to short right here on added that line. And again, I just showed you all those reactions there, why that line was added. There's still a possibility. My uppermost bounce target, if we happen to pop up on Monday, would be 73.59 or so. Um, Anything's possible. This is a breakdown. Um, a back test, let me say this, at this point in time, a back test is probably out of the question. We're a little too far away. You usually get a back test when you have a breakdown, and you're not too far away from the trend line. So anything's possible, but I don't think we're going to back test at this point in time. That would be, let's say my alternative scenario would be a pop-up Monday to somewhere in that 73.60 area. But my preferred scenario has us breaking down. I'll get to QQQ here in a second. In fact, let's do that now. Here's QQQ. There's that 170.69 level, which is comparable to that one I just showed you on NQ. And so when we look here and we really zoom in, you can see it here as well on the QQQ 60-minute chart, what looks like a possible bearish pennant pattern. This would be your impulsive move down, i.e. your flagpole. So if we take the distance of the flagpole, add it to where this breaks down, let's assume we move down on Monday, that's going to take us right down to about that second target area on the Qs, about 173.55. Okay, and also note that we do have that PPO signal line, the 9 EMA now crossing down below zero. That's the first time since right back here that we had it, and that was on that last correction where we went down and hit that second target zone. So sell signals look pretty legit on QQQ. Anything's possible, but as of now, based on all this, I expect more selling to come next week. And again, anywhere down to this, again, right now, just really eyeing this T2, but we'll certainly not rule out a move down to T3. And again, we're going to get to the daily charts here in just a second and wrap up. Before I do that, I should cover SP or the ES E-mini futures. Here's what happened. We also had a impulsive breakdown. We had this minor trend line that was highlighted recently. We broke below there. Very impulsive sell and smashed right through this secondary or larger, more significant trend line, and then stopped right at the button. Again, these are levels that were already on these charts last time this was covered. 2807.96 is where that level was, and as I zoom in, it looks like the bottom line is the technicals are certainly working, and they usually do work pretty darn good during times of increased market volatility, because that's what traders have to focus on. The fundamentals don't matter as much when you're in a pretty good sell-off. Traders then flock, even the professionals that might use fundamentals to normally pick their stocks. They really, I think, flock to the technicals as to where to buy. And of course, it also brings in active traders too. When the market's just grinding around, you don't have a lot of people. At least I don't trade, actively the NQ and ES. I like to get these quick moves, get in and out. You can make in a day what you normally make in a week when you have a period of low volatility. So that's that. And so what I'll be watching for, there's certainly the potential for ES to back test because it's not that far below that trend line there. So if you get a back test, look for a reversal. That would be an objective area to add. There's also some minor resistance right up there as well that might come in with a back test. Again, if we get one, that would be not my primary scenario, but my alternative scenario, and that would be a little push up like that. And then a move down. I still favor a move to at least this 27.96 area. 96 area on ES. SPY 60 minute, there's that most recent bearish rising wedge with the divergent high. There's a breakdown. As you can see, it's also very impulsive, which helps to validate that breakdown. Still plenty of support below for the SPY, so I don't think this market's anywhere close to meltdown mode or anything like that right now. I'm just looking for a little more downside. Anything is possible, but as of now, let's see what happens. So there's that. You can also see a similar flagging type action right here on SPY. So maybe we come down, probably hit this first target. That's T1's right there at about 278.19. This S1 just means support, first support level. T1 means that's my minimum target, minimum downside target. And again, you can see the targets there. So SPY trend indicator is still bullish, at least that 9 EMA, the signal line on the PPO. But again, based on the divergences here and the fact these negative divergences now are starting to play out with an impulsive move, I think there'll be more follow through to the downside next. Daily chart, again, not a lot technically has happened, or not a lot of significant technical events, I should say, on the daily chart. But what I'm watching right now is SPY, and I've mentioned this recently. SPY, other than this little blow off top that we had in January, followed by that sharp correction, since then, we've had 1, 2, 3, tested for a few days there. So 4 tests of this 279.80ish level and then a breakout. Now, number one, the breakout was very lackluster. Now, what you want to see on a breakout, like I just mentioned on the breakdowns that we saw today, they were followed with impulsive selling. That helps to validate it. And it's even more so important, I think, on long side breakouts to see an increased volume expansion, 1.5 times or better volume, impulsive selling, or buying, I should say. So where am I going with this? So far, we have the makings of a bull trap or a failed breakout. Now, we didn't fall back below there yet, but that's what I'll be watching for. So again, this next week, and if, I think we'll get it. And if we do, look for a move back down below 279.80. Then anyone who chased this breakout will have realized that they're wrong and probably start to unwind those positions, and the selling could begin to accelerate. So there's our uptrend line. Would obviously be the first support level on the daily chart, and then down here around 268.33 or so, we have quite a few reactions at that level as well. So look for that near-term targets. And by chance, if things get ugly next week, remember the most important thing are these lows, both on the Qs and the SPY. This is really, those were just brief spikes. So I'm really watching this level here, about 258 or so. And this is like the line in the sand level, 253. Again, those mark the two reaction lows from earlier in the year. And then the really big picture on SPY, we zoom out to a weekly chart that spans back a decade, goes back to the beginning of the bull market, which was in March 2009, April 6th, I believe, or March. And you can see that's a trend line that it really wasn't touched until, it starts off there, but then we started to have a lot of reactions along here. You can see as I zoom in. So 2016, and I also have an alternative trend line here off the 2016 lows. So if you zoom in tight, what you can see are a lot of reactions on both that primary as well as the alternative trend line here, and I'm looking at the white trend line, and we also start picking up that yellow trend line. So what had happened is on that second drop down earlier this year, we broke the yellow trend line, and it was a valid trend line in itself, a lot of reactions, but we came and we caught that long-term uptrend line. In fact, on the first sell-off down on the February lows, we hit that long-term trend line from off the lows in 2009, and then we've had a lot of candlestick touches on it. And again, if you see any moves below, those are just candlesticks. We have a couple candlestick wicks or shadows down below, or tails they call them when the shadows are on the downside. Wicks are when their shadows are up above. So there we go, a couple shadows below. That means intra-week we broke it, but on a weekly chart, all that matters are the weekly closing candles. And so we had numerous tests. Look how many times that trend line's been tested. So it's important to watch. And again, that's bigger picture. Now, I know the economy's on fire, everything's booming, strong GDP numbers, et cetera, but these divergences, if the SPY happens to make a new high, if it can take out that earlier high in January, and it does it anytime soon, we are guaranteed to have pretty strong negative divergences. So, if we don't move down next week, if the buyers step in and run this market up, I still believe, and I want to say this clearly, that I think the risk reward is not very favorable right now. The upside, let's say we run up, let's try to get this from where we close. Let's say we run up and make a marginal new high, 2, 3, 4%. So that's about the most upside I see before a significant correction. And then if we do pull back from there, we're probably going to confirm these divergences. So hard to say right now. Let's just focus on the short-term charts, see how they develop. Maybe this is just a pullback, a buying opportunity before a rally up to new highs. And we'll probably have a good idea next week. So let's wrap this up with QQQ. I already showed you the 60-minute chart, daily chart, what happened today. Again, not really anything damaging too bad from a technical perspective. Yeah, we had a big red candle. The Qs were down a lot, but there really weren't any key trend line violations or support level violations or anything like that. The Qs are still trading just off their highs, their recent all-time highs. These are all support levels. I know this chart's busy here. I'll give you the clean version here. This is what I'm watching. This line here, these are your divergence lines. So we had divergent high number 1, that drop there. There was divergence on the 60-minute chart that precipitated that drop, or preceded, I should say, preceded that drop. And then we have this rising wedge. Here's a trend line off the lows in April, pretty well defined. So let's look for that. So that should line up roughly with the targets I showed you on the 60-minute chart. So if we get there, we're either going to bounce, and since we haven't hit that trend line in a little while, we'll probably get at least a reaction there off that level and or those 60-minute chart levels. But if this goes, and I still think there's a very good chance it will, the technical posture of the Qs is pretty darn bearish in my opinion. We had a divergent high there. We have a divergent high right now, and you can see from the look of the PPO, it just crossed over. It looks like it's just making a bearish cross, or did today. The markets are closed now, so divergent high number 1, divergent high number 2. We had a little divergent high here, but this is just an extension. You just take these divergence lines and extend them as long as they're intact. So this tells me if that breaks, and this is the measured target, I've covered this before, add it to where the wedge might break down right about here and brings us right down to that those lows from earlier in the year, and that's a very important level, 152.84. So let's watch that, and there's also this long-term trend line here, multi-year trend line. on QQQ, and that's also a very significant level to watch. So I've covered this before. If we break this wedge and go on to break this trend line, look for maybe a move down somewhere on about around the lows from earlier this year, and maybe come on back up and back test this longer term trend line from below. That trend line comes off the 2015 lows in QQQ, which are also the early 2016 lows in the NDX. The NDX didn't have this candle that the Qs did, so that's that orange trend line right here I'm showing you. And finally, to wrap up the market overview, bigger picture. Let's always not lose sight of the bigger picture just in case things happen quickly. And that shows you going back the entire span of this bull market again to the early 2009 lows. Technically, the Nasdaq 100 bottom back in I think it was in 2000, late 2008, but it was the only index. And I often say this: the Nasdaq 100 really it's not a diversified index. It's like a tech fund, if you will, with Amazon kicker in there. Because of its weighting and lacks certain sectors of the economy like the other big indexes do. So what I'm showing you here are just all the divergent highs that I can find here on the weekly chart throughout this entire bull market. And you can see what the corrections were from highs to lows: 18%, 16, 13, 10, 26, 18. A little tiny baby divergent high right there. It was still good for a 4% pullback. Small divergent high right here at this point. That's this first line, 12% correction from there. And what we're doing is we're building some very large divergences on the weekly chart here. And this tells me that we're looking at something probably well into the double digits once these divergences begin to play out, or once they're, before they're said and done after they've played out. And you can see on that weekly PPO, remember this is a momentum indicator, it's rolling over. We had a little, look like we're about to cross right here at the crosshairs, pushed up a little bit, it's rolling, turning down again. So if it makes that bearish crossover and we start moving lower, then you want to watch for a break of this trend line, because again, this is a very significant trend line, same one off the 2015 lows. Finally, a quick update on that VIX trade I threw out there yesterday on the YouTube channel and to members of the site. I had a couple people ask me, Randy, are you taking this home? I'm going home short over the weekend. I don't see any reason why not to. Today's, everything I saw in the charts only reaffirmed and further solidified the near-term bearish case. And then when I look at VXX, it was up, it was up a little more than that day. Nothing explosive, but if I zoom in here, and I already covered this yesterday, so you might want to check yesterday's video, and I talk about these divergent lows and the rallies. Something to note too, you can see today's candle. First of all, the VIX is at the lower end of its range right now. VXX isn't going to track the VIX very well. All these VIX tracking ETNs are awful long-term holds. If you don't believe me, just look at a weekly chart. Look at all these 1-to-4 reverse splits. So the price split adjusted, back in here and back when the bull market started in 2009, if you bought this thing and you had 100 and, what is that, about 120 grand you threw into it, you'd have $31 today. Yes, that's not fuzzy math. That's the actual numbers. These things are awful buy and hold vehicles. But they're good, as I highlighted before. If you get in at the right time, you have to be selective. And so now the VIX is near the low end of its range. There's a bearish case to be made for the market. So if we can get one of these little quick double-digit pops, 20, 30% or so, great. And I think the risk reward's real good. And so what I was going to point out here is, volatility compresses when the market's rallying. You get these small candles. All of a sudden, you get a big candle. See today's candle? Although we didn't go up huge, it was, considerably larger, this big green candle right here. And you can see that is often the case here. Here's one right here, back on this other, right before the other pop. We had this period of low volatility, and then boom. Started out with a big green candle. We had a big pop. Things settled down for about the next week or so, and then whoop, there it goes. So, and I went back. There's a couple other instances. You can see that as well. So we'll see. And of course, I can tell you right now, the success or failure of this trade hinges largely on, the bearish scenario for the broad market playing out. Now we can rally a little bit next week. We can go and back test those wedges and things like that. And if the bearish case starts to erode, I'll do my best to communicate my thoughts right away. And like any trade, if you're in this, two things to consider. Number one, stops are a must with any trade. Pick your stops, whatever you're comfortable with. I like to use at least a 3-to-1 or better risk reward ratio. And the other thing is what I call beta adjusting your position size. Account for that extra volatility. If you're going to try to trade VXX, you need to give it a little more room. If you usually use 2-3% stop losses on trades, you're trading the wrong vehicle because this sucker moves that much in a day. And in a big day, this thing goes up double digits or goes down that much. So you have to give it a little more room, a little buffer on your stops. So how do you do that and still stick within your your loss allotment on a trade? Just cut the position size down, take a half, a quarter, whatever it is, so you can then allow yourself a 10% loss but yet not lose any more money than you might normally lose on a trade on, let's say, SPY, which you only have a 2% stop loss or a 3% stop loss. And again, the gain potential on this one from where we closed today, should this play out, I think, and I added a target here. I may add this on as an official trade for the members of the site, but if you're watching, let's take it. I like it. Official, unofficial, 6 to 1 F doesn't matter. I'm in this, and I don't see any reason. It's an aggressive trade. I'll say that, but there's the target right around 39.10. Even though the resistance is a little bit above that, I like to set my sell limit orders just below. And this is the if things get ugly target. And again, trying to measure that out, 75% roughly from where we closed today, with a minimum target of, grab that, from where we closed today, about still another 26%. All right, let's wrap it up here. We'll see what happens next week. All right, I think that's everything I wanted to cover. Nope, I knew there was one other thing. IWM for you small cap traders. And we actually have an active trade on the site on this one as well. That's based off the 60-minute chart. But what happened today is we've had this recent consolidation range right there. You can see it on IWM. There you go. And boom, big red candle down through there today. So IWM's not looking so hot or looking good if you're short this one. And again, that's an active trade on the site right now. We'll base that one off the 60-minute charts with the price targets on that one. So we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great weekend.